Welcome to another episode of Good Value by Antipodes.
For much of the last 15 years, investors have enjoyed a bull market led by US mega-cap quality and growth stocks. Index funds have delivered strong returns, and for many, investing in global equities has felt easy. But markets don't always move up in a straight line, and for investors trying to build a resilient portfolio, the question is, what comes next? I'm Alison Savas, and today I'm joined by Anthony Doyle, Chief Investment Strategist at Pinnacle Investment Management. Anthony has spent over 2 decades navigating global markets across equities, fixed income and multi-asset strategies. And today he spends most of his time speaking to investors about asset allocation and portfolio construction. In today's episode, we're diving into 2 big themes: the active versus passive debate, and how to think about asset allocation in today's uncertain environment. Anthony, welcome to the podcast.
Cheers, Alison. Great to be here.
Let's start with active versus passive investing, because it's been one of the biggest shifts in investing over the past decade as flows into index or passive funds has surged. But today, the main indices are heavily concentrated in a handful of large companies. So how do you think about passive investing in today's environment?
Yeah, you're absolutely right, Alison. And if we think about what was the regime shift that really saw index fund and passive investing grow in prominence, it was really the reaction to the global financial crisis. Ultra low interest rates, quantitative easing, money printing. You saw assets go out the risk spectrum and particularly find their way into equity markets. And why not? Equity markets are a fantastic asset class to generate long-term returns. So passive investing has worked brilliantly for 15 years or so because it captured that mega cap tech rally, as you mentioned. But there's an uncomfortable truth, and a lot of investors are aware of it, particularly in Australia and also offshore. And that's that we're now sitting on the most concentrated S&P 500 and ASX 200 since the dot-com bubble. So the top 10 stocks for the US represent around 40% of the index. If you think that's concentration risk, the top 10 stocks in Australia, 50% of the ASX 200. So, many will talk about the low-cost nature of passive investing, the diversification benefits of passive investing or index investing, but that's not diversification. That's a massive sector bet disguised as broad market exposure. So when you buy the S&P 500 index today or the ASX 200 index today, you're essentially making a concentrated wager on 7 to 10 tech companies, or in the case of Australia, 4 or 5 banks and the mining sector. And when you consider that of the 24-25 return for the ASX 200, 44% of that was because of CBA. So you're even making a more concentrated bet on one particular stock. So that's not passive investing anymore. That's active concentration with passive pricing.
So at what point do you think passive investing stops being that low cost, low risk option? Or given what you've already just highlighted, are we perhaps already there?
Yeah, well, to think that you invest passively because of its low cost nature, it's like saying, why should I wear a seatbelt when I haven't crashed yet? And so the risks of that concentration are rising. And it's really why you need to think about taking an active approach, whether that is blending it with a passive exposure or moving entirely towards active investing. Finding an investment manager that has a philosophy that's been managed throughout different market regimes, a transparent and repeatable investment process, a manager that is aligned with your own views for what you are seeking from a particular asset class, particularly in terms of risk-adjusted returns. So today, many investors are trained to buy at any price. They think it's acceptable if the company is large enough. But for me, that's not sustainable. It's not a sustainable investment principle. It's momentum masquerading as a strategy. So when the fundamentals will inevitably reassert themselves, as I anticipate they will in the next 18 to 24 months, passive investors will be left holding the bag because they can't adjust quickly, they can't hedge, and they can't exit stocks that they don't particularly like, that they think that their world won't be as favorable as they have been, or the world operating environment won't be as favorable as it has been to these companies in the past. So with that in mind, it is certainly the case that when we look forward, the coming 10 years will look very different to the last 10 years. We know this, whether it's globalization, whether it's having a cost of capital, whether it's rising inflationary pressures. There are companies that will do better than others within sectors. There'll be sectors that do better than others. There are regions that will do better than others. And you really need to be forward-looking in making that assessment. You can't be passively blindly buying the winners of yesterday.
I really like some of the things that really stood out for me in your commentary was that it's probably not giving you the diversification that you think you're getting. And some of those concentration risks are outstanding. That comment around CBA being 44% of returns, is almost mind-blowing. And I particularly liked momentum masquerading as a strategy. And I think they're things that we forget. When markets are going up and we're experiencing the good times, it's great to be on for the ride. But as you said, the next 10 years is going to look different. And so we need to be thinking forward and positioning for that. So, that's a great segue into the next part of what I wanted to discuss with you today, because that active versus passive debate does sit within that much bigger picture of asset allocation. And that is something I know you spend a lot of time discussing with clients. Now, from your recent conversations, what are some of the key trends or common positioning that you're seeing? And have there been any surprises?
Yeah, absolutely. So as you mentioned, I work with all of Pinnacle's affiliates clients, whether that's superannuation funds, institutional investors, investment consultants, financial advisors, direct investors in ETFs. I speak to a vast range of investors. And the one area that has been a keen focus over the last 3 to 4 months, particularly since Liberation Day, has certainly been that global equities allocation. So investors are highly aware of the risk and concentration that exists in market-based indices today. They're aware of that. But for the first time, we're seeing pockets of the market beginning to underperform. And we are seeing a broadening out of gains. And certainly when I look around markets, there are extremes that exist at sector levels, at market cap levels that are screaming a great opportunity today with a long-term view. So on the global equity side, I think April really scared a lot of people, given the sell-off that the market had, in particular, 12% drawdown, 15% drawdown, depending on which equity market you're investing in. And certainly there's been a focus on examining global equity portfolios and thinking about building appropriate diversification within their global equity portfolios, whether that's from a factor perspective, a geographical perspective, or a sector-based perspective. So a big focus on building diversification into global equity portfolios. There's also been a case where many investors may have owned a factor like the MSCI Quality Index. It's done super well for 15 years, but that factor being inherently backward-looking, we're starting to see significant quality traps begin to emerge. So the MSCI Quality Index has underperformed the broader market by around about 9% over the last 12 months. And so investors are wondering why that is the case. But certainly you shouldn't own factors as a core exposure. You own them as a satellite to complement any core exposures you may have in a more diversified equity portfolio. So global equities, certainly big focus on income as interest rates are falling around the globe. So looking at both the equity market and more defensive asset classes like public fixed income, private credit for generating higher yields and higher incomes. And I am seeing a lot of portfolio rebalancing. So despite the run-up that we've seen in equity markets, I am seeing investors not necessarily move out of equities, but rotate some of those exposures from passive index style investing to one of a forward-looking active manager. I've seen investors allocating more to value style managers and both more to growth style managers, quality growth style managers, because certainly not all value is created the same and not all growth is created the same. So you really want that forward-looking approach from managers that do have a proven track record.
And in your experience, where do investors most often go wrong with their asset allocation? Is it at the outset or, with that initial construction, or is it how they respond to market moves?
Normally, the initial construction is good. So that's not usually the problem. The problem is we're humans and we have behavioural biases. That's normally the problem. Study after study shows that investors like to say they're long-term investors, but when market volatility spikes, their investment time horizon collapses to what the hell is going on. And, it's a big sticker shock to see your super balance, having big losses on it. And it can scare you. And, I have anecdotes of clients and friends going to cash during April, and despite better judgment. So it's less about the SAA is normally good. The strategic asset allocation is normally good, but it's our behavioral biases that can often see us selling assets that have underperformed. So with that in mind, it's important to have, it really speaks to our advice model that we have with financial advisors, that they can hold their clients' hands through the good times and be measured. But importantly, when volatility spikes and you start to see that those negative headlines start to hit the news and hit the front page of newspapers, that advisors talk to their clients and articulate, there isn't a return without volatility. And most importantly, your long-term goals, there's no wealth generating machine like the equity market. So having that long-term perspective, dollar cost averaging strategies often work extremely well when the markets draw down. So
we've got an environment where we've got political and geopolitical uncertainty, global equities around their highs, and as we've discussed, the major indices are arguably unbalanced. So how should investors think about building that resilience and diversification into their portfolios so that they are protecting their capital? And you spoke about that fear around drawdowns or that sticker shock. So we want to protect our capital, but we still want to capture the upside. So how do we go about doing that?
Yeah, absolutely. So, we need to understand and be aware of concentrated risk. Personally, I love concentrated investing, but that's an appropriately managed portfolio that can be built. Academic studies suggest you can diversify within a portfolio with as few as 15 stocks. So you're looking at intra-stock correlations within the portfolio, that you are well diversified across sector, region, different types of companies such as value style companies, growth style companies, cyclical style companies, defensive style companies. So there's nothing inherently wrong with concentrated investing. It's where the risks are highly concentrated. So your portfolio is moving up and down as one.
Together.
Correct. Absolutely. So true diversification is having appropriately weighted risks within a portfolio, whether that's an equity portfolio or wider portfolio of diversified assets. And often when we talk about building a resilient portfolio, well, sometimes in a multi-asset perspective, it means owning assets you don't necessarily want to own for a rainy day. And often some of the best things you can do when the sun is shining is actually make hay and rebalance the portfolio, given your investment time horizon. So what you're looking for today in a global equity manager is, as I mentioned, managers that have a disciplined process, that have managed through many different market cycles, that have a clear investment philosophy, and managers that are flexible, that can underweight certain parts of the market that are likely to underperform going forward. So the big trade has been the Mag 7. We all know about the Mag 7, but we're now seeing bifurcation within those 7 stocks between the Amazons of the world, the Microsofts of the world, versus companies that might be caught up in tariffs like Apple. We are manufacturing items in China. And then, the outlook for companies like Alphabet with the rise of ChatGPT, for example. So it's important to make an assessment. What's the fundamental outlook? What's your bottom-up research telling you? And does the risk justify the rewards of allocating to a particular company.
Do you think investors perhaps, in this, you've spoken about, we all know what the Mag 7's done. I mean, they've been an outstanding part of the market to be in, and we know what the AI trade is doing. Do you think investors are overexposed to growth and quality? I suspect they are, and perhaps maybe they're not as aware of it as, maybe they're not as aware, or maybe they're just worried that fear of missing out if they go higher. To what extent are you seeing that play on investors' minds in terms of thinking about that rebalancing piece?
Yeah, I mean, I think it comes down to your risk preferences and your investment time horizon. So, I mean, I think AI is transformative, and the market obviously does as well. Now, the key is to work out these companies that are generally trading on higher multiples, which justify the multiple and which are totally unjustified. And when you think about momentum, when you think about narratives that can persist in markets, I mean, it wasn't that long ago that we were going to never go back to the gym. So that's why Peloton has had generated such a large amount of interest and was trading on eye-watering multiples. Moderna was going to change the world. PayPal was the dominant payment system that we weren't going to eat beef anymore. We were going to eat lab manufactured meat like Beyond Meat. And we were going to Zoom everyone. We weren't going to meet face to face anymore. Now, all those companies that I've mentioned have derated between 80 and 95% since the COVID booms. Obviously, there's different cases of being disrupted, or they couldn't capitalize on market share, or they didn't have any pricing power. And obviously, investors in these growth and quality traps, they wore all of the downside if they were passively invested. So, I mean, I personally love quality growth stocks, but I love value stocks as well, defensive stocks, cyclical stocks. There are opportunities across the marketplace, but it's whether an active approach, a forward-looking approach, is capturing those opportunities. Now, certainly there's awesome opportunities in quality growth, but as we've seen this year, value has done very, very well, particularly in Europe. And so it's having an active manager that can make those assessments, avoid the drawdowns, but participate in the upside.
And again, great segue, because I want to talk about value, because I think that to a lot of investors, value still means, or, value is associated with only buying low multiple stocks. So low PE, low price to book stocks. And that is a very narrow view of value. How do you define value in today's market? Because you spoke about AI, being a great thematic for the future. So in the market that we're in, how do you define value? And perhaps, to bring it to life, share an example of a company that you think does challenge that very traditional view of value.
I mean, one thing that I find fascinating in markets is these broad churches where you're an acolyte of a particular discipline of value, quality growth, cyclical investing. If you're an equity investor, you're optimistic. If you're a bond investor, you're bearish. And typically what colors your view is the job you got out of university. And so those of us that are wedded to history may be missing what's going on right before our eyes in terms of transformative change. Economies are never stagnant. We're evolving all the time. Economies are always evolving, creative destruction, new opportunities emerging, and particularly given some of the regulatory and globalization changes that we've experienced over the last 20, 30 years, we know that the world is going to look very different in a decade than it was 10 years ago. So when it comes to value investing, those of us that are wedded to a particular definition of value, I think are going to suffer. Whereas certainly, one thing about Antipodes, being pragmatic. So don't be wedded to a definition of value. Don't be wedded to a definition of quality, but rather be more pragmatic. And there are companies that trade on high multiples that are value in terms of their ability to continue to grow earnings, does their higher multiple than the market represent value to those growth prospects going forward? Because inevitably over the medium to long run, don't get caught up in the noise of quarterly reporting, share prices will follow earnings. It's very hard for a company that is upgrading earnings for the share price to decline. More often than not, the share price will follow earnings. So a classic case for me today is Amazon, for example. And the market was slow to recognize the transformative change of that business, has caught up to it and trading on about 30 times multiple today versus the wider market at around 18 times for the S&P 500. But the question is, that company has evolved from a consumer-facing, consumer discretionary type stock. It's still classified as that, according to many risk systems. So it's still compared to Walmart, Lululemon, Nike. But obviously, the thing that dominates the outlook for Amazon is its platform, and in particular, AWS, which is now responsible for 25 to 30% of its operating margins, and it's growing earnings north of 20% per annum. So I would argue that Amazon is a value stock. We shouldn't be getting caught up on narrow definitions, which you often find comes from the quantitative side of quants wanting to bucket companies into certain types of styles or buckets. This is where a fundamental active approach and being pragmatic really rings true. Let's not classify companies according to backward-looking screens. Investing is all about being forward-looking and what will the world look like in 10 years' time. So Amazon is a classic case in point where many might classify it as a quality growth stock. Well, actually, probably sits pretty nicely into a value style of approach as well.
Now, you touched on in one of your earlier answers on the idea of traps. And I think, we often hear about value traps, these low multiple companies that never, mean revert because they're being outcompeted. So the idea of a value trap is sort of, I think, quite well understood. But, and you mentioned this earlier, but there are also growth and quality traps, especially after a long market cycle where valuations do, tend to go up and up and up. And you called out some, the likes of Peloton and Zoom, some really interesting companies where you had this over extrapolation of certain thematics of certain growth profiles. And, ultimately that's what a growth trap is. It's a company that's does grow very quickly. It re-rates on that high growth profile, and the market assumes that growth rate is permanent. But then ultimately with the growth trap, it's unsustainable or it proves illusionary, and you get the D rate. But how do you think about avoiding traps in the market, more broadly?
Yeah, Alison, the key insight here is that all styles can become traps when taken to extremes. So growth traps actually underperform more severely generally than value traps because growth stocks tend to have those lofty expectations. And in a world where risk aversion is declining, interest rates are falling, fiscal stimulus is strong, we're now starting to see meme stocks rising within the market again. And the classic was GameStop. A couple of years ago during COVID, where short sellers got squeezed because of a Reddit thread called Wall Street Bets, and GameStop, bricks and mortar game retailer, a big short book on it, and actually we saw the share price rapidly appreciate. Are we starting to see some of that bubble characteristic, not only in terms of the market, but more broadly in things like crypto, for example, where excess liquidity and the opportunity to make a quick buck and an outsized return and generate extreme wealth is attracting investors and speculators rather than investors, I would suggest. And it's a tale as old as time. It's amazing when you think about, tulip mania, these toys that are selling off flying off the shelves, whether it's even when I go back to primary school, trading cards, it's human behavior 101. And so all those styles can lead to traps. Growth stocks typically, growth traps typically underperform to a greater extent than value traps. Quality traps occur when investors overpay for past excellence while ignoring signs of deterioration. BlackBerry, remember Blackberries, Crackberries? Nokia, Intel in the headlines more recently, PayPal, as I mentioned earlier. And so the question is, are these companies being disrupted, or are their competitive advantages eroding because of disruption? Now, the solution is combining these styles with that strict valuation discipline. So, when it comes to value, look for, momentum alongside value, quality metrics, depending upon the price that you're paying, and always have a margin of safety regardless of your investment thesis. And really, it's only a forward-looking approach that can do that. And it's only hard work, rolling up your sleeves, bottom-up fundamental analysis that can do that. So much of investing is human judgment. As much as we want to trust the machines and trust the algos, in a world that is increasingly being dominated by the levered dollar, it is important that fundamental investors can time arbitrage, take a long-term time horizon, and generate those returns that investors want from their hard-earned savings over a longer time period than simply what's going on this month, next quarter. Even a year is too short in equity markets.
It really is about looking through the noise, isn't it? You really have to be disciplined to look through the noise and take those advantages. As you said, if we do get a wobble in markets, perhaps that does represent the opportunity.
That's what I saw in April. I'm in a fortunate position that I work with all of Pinnacle's 18 affiliates, and the market sold off very aggressively. And overwhelmingly, when I spoke to Antipodes and our other affiliates at Pinnacle, our portfolio managers were looking to put money to work, particularly for those companies that may have been on their bench and the valuations fell into their wheelhouse to take an allocation. And generally, it's been a very positive experience relative to the forced sellers of quant-style funds that are all positioned the same way, algos, hedge funds, investors investing on margin that were all forced sellers. So these momentum-type strategies can dominate in the short term, but as I mentioned, fundamentals win out over the long run.
Now, I was listening to you. You made a great comment at a conference recently. And the comment was, I'm going to have to paraphrase, it's a crime that super funds are putting younger investors into balanced funds. So how would you structure a portfolio for a teenager today that they could hold for the next 15 or 20 years? And having children on that sort of, I'm taking notes here.
Yeah. I mean, when those comments on super funds, it's not the super funds as such, but, I think our politicians should have a good hard look at this. If you're a kid working at Macca's, 14, 9 months, 15 years old, why are you being placed into a default option for a super fund? And obviously now there are age-based type options as well. But my view is you should be 100% equities, particularly if you've got 40, 50 years till you retire. And governments are probably going to be increasing the retirement age as populations age going forward as well. It has to be 100% equities. And, the default option should be 100% equities. If you're a 15-year-old kid, you probably couldn't care less about super, right? But it will be thousands, hundreds of thousands of dollars of difference by being invested in a growth asset class like equities to even having a small allocation to defensive assets. Now, one thing that I'm seeing that's really interesting at the moment is that a lot of Australians, in some cases, want to pass wealth on to the next generation. Probably reflects the large amount of housing wealth that's been generated over the last 30, 40 years. And so even defensive or historically typical defensive style investors, so such as retirees, are also very happy to have an equity allocation, because when they pass the wealth on to their younger generation, well, they have a very long time horizon, whether that's Gen X or below. So it has to be 100% equities for me. And maybe Albo's listening. Maybe Jim Chalmers is listening.
I'm sure they're subscribers.
I think it's, I'm sure they're listening. I think it's a quick win. And so, not to be too critical about government policy, but we know the impact that allowing Aussies that $20,000 during COVID that they could withdraw from super. Look at how the market has performed since those dark days of the pandemic. Now, obviously, I understand the justification for allowing that. I'm not going to argue, but one thing we do know is that equity markets have generated an excellent return since. And so if that $20,000 had remained, then certainly that is going to cost investors over the long run by withdrawing that money from their pension or superannuation fund accounts.
And actually, you did mention that idea of even in that pension phase. I guess you have two phases of your investing life. You've got your accumulation phase when you're a bit younger, and you can afford to be very invested in the market because you've got a very long-term horizon in front of you. And perhaps when you're in your pension phase, it is a little bit different because you're not getting fresh capital. Now, it would be remiss of me to not do a shameless plug for one of our own products. Compliance, thank you. But, a long-short strategy or a variable beta strategy can be very powerful in that pension phase. You are capturing that upside, but, that the long-short, the lever of the short, you can pull that in times of uncertainty, which can also, build in a bit more capital protection in a time when you are focused on that. So you set me up nicely.
No, absolutely. I mean,
unscripted.
You can minimize the drawdown. When markets inevitably recover, you're starting from a higher point. And over the long run, that's when you really see exceptional returns relative to the index. And so you're absolutely right. Strategies that are flexible, managed by an experienced team that have a track record of utilizing that flexibility during market dislocations. It is an appropriate investment for those types of investors that are seeking to protect on the downside as well as capture the upside.
That's right. Now, final question, because we're about to wrap up. Is there a person or a resource or a podcast, besides this one, obviously, that you turn to for fresh perspectives on markets?
Yeah, I mean, absolutely. I think one of the best biases behaviorally that we can counteract as investors is confirmation bias. So you can hear I'm generally pretty bullish on the world today. I think that the market tailwinds are there for equity markets to continue to rally for the next 24 months at least, with lower inflation outcomes, lower interest rates, strong fiscal policy, resilient labour markets. I think that equity markets continue to rally. That said, there will be a cost of capital in terms of the risk-free rate, which will settle around 3%. The bond market is telling us today. So you have to be highly selective. The past winners won't necessarily continue to generate those sorts of outsized gains. And even this year, in Australia, we've seen small and mid caps outperform large caps. CBA has been underperforming. In Europe, Europe's largest stock has massively underperformed, Novo Nordisk. So that was a big risk for passive type investors. And as I mentioned, in terms of the outlook for the Mag 7, we've seen some of the biggest names in the land underperform the wider market, and gains really broaden out to mid caps and small caps as well. And generally, I get a lot of content from our range of affiliates as well, both bullish, bearish, and in between. And that's the great thing about having a suite of 18 affiliates that are investing across many different asset classes with 80 different products for the retail market here in Australia.
Thank you so much for your time today, Anthony. Some fantastic and interesting insights, and thank you for sharing them on the podcast with me.
Cheers. Thanks for having me.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.